Investors Chronicle.
Hello, Happy New Year, and a very warm welcome to Lee and the IC, the podcast in which we here at the Investors Chronicle, or more specifically me, Alex Newman, an associate editor on the magazine, get to pick the brains of Lord John Lee of Trafford, Lib Dem life peer, ShareSoc patron, chartered accountant, former High Sheriff of Manchester, and most importantly for our aims, a die-hard investing enthusiast. Happy New Year, John. How are you doing?
Fine, thank you. Happy New Year to you.
How was the festive period?
Pleasant, very family. Had a very, very enjoyable couple of days away on the coast, Norfolk, Blakeney, which was stimulating and fresh, but not seen any snow.
Okay. Did your broker get a break for a couple of days, or were you checking things?
I always check things every day, but things have been pretty quiet and next to nothing happening this week. But I'm expecting over the next couple of weeks a number of trading statements from companies I'm invested in, which I hope will be encouraging.
Do you tend toward optimism at the start of a new year?
Not every year, but this year I am optimistic for a number of reasons. Firstly, I think it's generally accepted that the UK stock market is at a lowish level and many UK companies are very attractively priced. So I think there's going to be quite a lot of M&A takeover activity during 2025. Secondly, a lot of the companies that I'm invested in that trade globally, like Kempario, Concurrent Technologies, Goodwins, they're trading well. Obviously, it's going to be much more difficult for UK companies that just solely focus on the UK market, because obviously our economy is not in a particularly good state at the present time. National insurance increases are clearly going to hit the retailers and restaurateurs and hoteliers in this country. Thankfully, I'm not in those sectors. So underlying trend from a lot of companies I invested in, pretty good. And thirdly, on dividends. I mean, last year was a very good year for dividends from my point of view. And of course, it's still possible to get these historically very high yields from the M&Gs, the Legal and Generals, the Phoenixes, the supermarket Reit, which we may talk about later. Yields, Aviva maybe, but 8 yields, 9, 10%. Hugely attractive from major companies in historic terms, although there hasn't been any real capital appreciation in those stocks. I think it will gradually come as interest rates do begin to fall. But at the moment, clearly, there is an indication interest rates aren't going to come down as fast as was earlier expected, and therefore there's been a little bit of a pause and uncertainty amongst those larger stocks. But when you think you can put those into your ISA and get a tax-free return of nearly 10%, well, it's a wonderful opportunity, a wonderful period for investors with cash.
Yeah. We've got a lot to cover this month. I think as you've pointed in several directions already. We're going to return to our normal format, which means a review of sorts of 2024, some changes in your portfolio, John, and also taking a closer look at a couple of companies in the portfolio. Before that, we do need to start with a familiar reminder that everything we talk about on this podcast is for educational and entertainment purposes only, and that none of it should be taken as financial advice or a recommendation to buy or sell shares. On this podcast, though, we do try and spend as much time as we can looking forward. That said, and I do want to look forward for most of this one as well, let's just begin with a quick look at 2024. Do you follow the investing industry as well as, I suppose, many personal investors and listeners in measuring your annual performance, John? And I know in one of your books you did break down your annual performance, particularly throughout the crisis.
I'm not obsessed with it.
Okay.
Because I don't set myself any targets or similar. It really doesn't concern me. A short-term, one-year performance doesn't really concern me. Obviously, over a longer period, you do want and do hope and normally achieve growth. But I did look back at 2024 just to see in statistical terms what had been achieved. And in my ISA, which is by far my largest portfolio, I can put it that way, I got an overall return of just over 13%. That included reinvested dividends, which probably made up something like a quarter of that 13%. So overall, it was quite pleasing. On my smaller portfolio, which is the non-ISA portfolio, that was a little more disappointing and probably just broke even over the period. But overall, in financial terms, I was particularly pleased with the flow of dividends, which was extremely good. And, I look forward to an increase in them this year.
I'm quite surprised, actually, that it was only a quarter, given how chunky some of the yields are on some of your biggest holdings, the life insurers you mentioned. When you're measuring performance, or okay, you're not doing it very, very rigorously, you're not setting yourself goals, but you are also, from what we've talked about on past episodes, someone who receives some dividend income as well as reinvesting it. Does it make a bit trickier to measure it?
Not necessarily. My approach at the moment, and has been for a number of years, is to take my non-ISA dividend income personally, as it were, for personal expenditure, and to reinvest the ISA dividend flow, which thankfully is quite substantial. You asked the question, why only 25%? The answer is that one or two of my larger small cap holdings either pass their dividends or paying a very low dividend, like Christie's, like Concurrent Technologies, and I look to them to hopefully begin to increase their dividend payout. And also companies where I have a large holding like Reit, for example, and to an extent Goodwin as well, and one or two of the more recent ones, they're lower yielders. So the overall ISA portfolio is a mix now of a number of the high-yielding stocks that we mentioned and a number of those small stocks which are more focused on capital appreciation. So overall, we probably get a dividend yield of, worked it out exactly, but it's probably getting on for 4%, something like that.
Okay. So, I mean, one of the, I suppose, smaller in terms of market capitalization terms, though your holding is fairly substantial there, is Christie Group. It's a company that went sideways in 2024, and I guess there's been something of a disappointment in share price terms for a bit longer than that. Like I said, it's a small company by the standards of the stock market, quite thinly traded. Also, not one we've covered in much depth here, though it has attracted a few listener emails. What's the backstory to your holding here, and what does the company do? It's not that easy to work out, I would say, from the corporate literature.
First of all, people get confused with the name Christie and think it's the auction house, or in the north, the Christie Hospital, where I actually used to be chairman some years ago. So there is a degree of confusion there. But no, Christie itself is probably the premier name in the buying and selling, from a broking point of view, of hotels and pubs and restaurants, and is also the leading broker in a number of specialized fields like pharmacies, dentistry, care homes, nurseries. It's a valuable brand that has been built up over the years. This is not reflected in its stock market capitalization, which is very low. I think it's one of the most substantially undervalued businesses in the market. This is explained by the fact that it is very much family controlled and liquidity is tight. But I've always believed that value comes through in the end. And I'm sure at some stage that value will come through with Christie in some shape or form. Whether I get the benefit or my heirs do, I'm not quite sure. But value will come through. But in the shorter term, what investors haven't appreciated with Christie is that they have disposed very well, I think, of their loss-making stock-taking business, which was geared to retailers, for example. They've retained the stock-taking that covers hotels and restaurants, as I understand it. And that was the loss maker. So that dragged down the bottom line performance. That has now ceased. They've sold that and they got a good cash sum for it. I think they've cleared all debt. And, I look forward to a steady appreciation in their bottom line and in their share price.
I suppose that one of the other results of that is that it makes them a bit more of a cyclical business again, doesn't it? Because I think the stock-taking business, if I remember correctly, was with a view to managing through the cycle revenues.
Yes, I think that's fair. What a company like Christie needs is activity. And obviously on the retail side, it hasn't been easy. We had COVID, so firms weren't focusing on stock taking. And then, of course, we've had a number of big retail closures like Wilkinson's, Wilko, as an example. So, that made that business more difficult. But on the basic broking side, what they need is activity. And what I see coming up over the next 12, 18 months is an increased level of activity, because clearly these very negative national insurance increases are going to make life very difficult for certain businesses. So I think there are going to be quite a lot of forced sales and other buyers seizing the opportunity to pick up new sites and new properties. So I think there's going to be quite a lot of activity in that sector, which hopefully once again will benefit the company.
Is this a loss-making holding for you? Did you buy in at it with the value proposition?
I've had it a long time.
Okay.
The shares were a lot higher. When they were floated about 30 years ago, they were floated at something like 145p a share.
Okay, wow.
The business has grown very substantially in terms of offices and reputation and brand, and yet the shares today are only just over £1. I mean, it's quite extraordinary. And they have been up to approaching, I think, £3 at one stage.
There's some causes for optimism here. You're hanging in there with Christie. I did want to just ask, because I thought it was a really good question we had from a listener, Andrew, who asked what you would do in the situation. Okay, perhaps not with Christie, but one where a considerable amount of patience is required, and you are looking at a loss of 50% plus. Do you set limits to patience? In other words, do you have a point at which you cut your losses?
I understand what you're saying. The answer is that I don't have a specific point, and I would hold up my hands and say I'm probably too loyal to some of the companies that I've been excessively patient with, and many people would have moved on. But I tend to take the long-term view, to build up biggish holdings in a smaller number of companies. And also I get to know them. I have a relationship with them. I meet the chief executive or the chairman, and they become, in a way, part of my life. It's not just a sort of an academic financial exercise, not getting involved with the companies at all. I believe in the companies that I'm invested in. I enjoy talking about them and getting to know them, as it were, maybe at the expense of overall financial performance. But to me, it's been a big part. The stock market and investing in these small cap stocks has been a big part of my life. And in looking back, I really wouldn't have changed it. And thankfully, overall, we've had many more successes than failures.
Should we take it then that on a matter of strategic or material importance, you would be in dialogue with, I know your holding in Christie is quite sizable, it's something like over 5% of the
Yes, that's not my personal holding, but,
okay.
But that's my personal holding together with funds that I influence, put it that way.
Okay. So would the board seek your thoughts on various transactions they might do?
Yes. Well, I wouldn't say that they phone me to say, we think of doing this. What do you think, as it were? But I do have a fairly continuous dialogue with companies like that and know what they're doing and thinking. Obviously, if I disagreed with something substantially, I would say so, or I could obviously sell the shares. Do they come to me before they do things? Sometimes. I remember, without mentioning any names, one company came to me where I'm an investor and said, if ever we were bid for, what sort of price do you think you would accept? So one does get sounded out from time to time, just as many of the large institutions do who've got big stakes in some companies, and they're approached to see if they'll dispose of that stake at a certain price as really a platform for a possibly potential bid.
I think it's interesting insight for a lot of our listeners. Andrew's asked what you might recommend investors who, compared with your level of access or holdings, might struggle to engage with boards or executives to the same degree. Or do you take the view that any company should be prepared to respond to all of its investors?
Well, most companies are willing to respond. And I think the fault, if I may say so, actually lies with individual investors themselves who think they're unimportant and don't approach the companies concerned. And I'm quite sure in the majority of cases, if they were to try to speak to the chief executive or the financial director or the company secretary and try to speak on the phone or send an email, they will get a response, even if the company might regard liaison with them, discussion with individual small shareholders as a bit of a bore. Nevertheless, they will do it out of courtesy. And of course, you do have this opportunity. Every shareholder has the opportunity of going along to the AGM each year, which is a wonderful opportunity to actually, in the margins of the meeting, when the meeting's broken up, after the formalities have been carried through, over coffee, to converse and meet. This is why I was very angry a couple of years ago with Marks & Spencer when they tried to bring in a totally digital AGM, and effectively were planning to bar shareholders from attending. And I thought this was pretty monstrous and objected pretty strongly. I'm glad to say that they, I think, now realise that the way forward is a hybrid AGM. The shareholders can come and meet or actually participate by Zoom digitally.
Let's park Christie and move up the food chain a little bit.
You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information.
Last year, listeners may recall that you correctly called the bluff of the Carlsberg board by buying into their takeover target Britvic after the Danish company's initially lowball offer. When we last spoke, you were umming and ahhing, I think, with making a similar wager, this time with Aviva target Direct Line. How did that all play out?
Over the years, I've been on the receiving end of over 60 takeovers and take privates. They've formed a very important part of my overall portfolio building. One has studied takeovers, and of course, one never knows when a takeover is going to happen. Something can happen tomorrow morning. You just never know. And that does add to some of the, part of the excitement of an interest of investing. And as I've said a little earlier, I think next year is going to be a really good year for takeovers. Last year, the only one that I had, but it was a significant one, was the takeover of Lock and Store, which produced a very good profit for reinvestment in my case. But one of the things that one does learn is that when a major company swoops on a smaller one, it usually has done a lot of work in terms of due diligence, as it were. It's taking a very long-term view, not just looking for a short-term asset strip or breakup. So it's taking a long-term strategic view, and normally it's much bigger than the prey, the predator much bigger than the prey. And also pride comes into it as well. I mean, a major company does not want to be seen to be thwarted on a takeover. Now, obviously, they all have a certain price in mind at which they're not prepared to go beyond. But the usual method these days is to put in a reasonable sighting shot, which is normally pretty well dismissed out of hand as the receiving board say, this substantially undervalues our business and go away sort of thing. And that, of course, is anticipated. And usually the big buyer, like Carlsberg or like Aviva in the Direct Line case, have got something in their back pocket. And so I think in the end, and I didn't actually buy Direct Line, but I should have done with the benefit of hindsight. I for whatever reason, I can't remember exactly, I didn't. I think in the end, Aviva paid something like a 70% premium on the original price of Direct Line before the bid broke. The average premium last year was around 45%. In some cases, it was up to 100%. And in the case of Mars' takeover of Hotel Chocolat, it was substantially above that. I was never quite sure why they felt the need to pay that amount of money, but nevertheless, they did. I'm expecting a lot of takeovers. I'm expecting good premiums. And almost certainly the big companies, if they are bidding, will not just walk away if they're spurned initially, that have played the game through, as it were, that have worked through the battle. At the end of the day, they'll be pretty determined to actually make sure that they win without massively overpaying.
So, as well as your regular portfolio management this year, you've got a side hustle in special situation.
Occasionally. And I do a little bit of jobbing in and out of Goodwins, which is holding I'm very positive about, a great British engineering company that is just hardly known. But because it's heavily family controlled, because it's in 250 indices, funds have to own it, or some funds do have to own it, and it does jump about quite substantially. And so I have traded 2 or 3 times in and out, as it were, quite successfully, just as a sort of a fun thing in a way. But of course, I do have a substantial core holding in Goodwins that I built up because I think it's going to be it has been a wonderful share over the years, and I'm pretty confident there's more to come.
Certainly one, I think you said in the past, one to stay the course with. Another UK market stalwart, which I think like Direct Line fell out of the FTSE 100 in the last couple of years, is ITV. I mean, last year that was another company that you pointed to a strong valuation case under the bonnet, although the shares have really kind of taken a battering in the last decade. I think they're off about 3/4 from their 2015 high. And we know the story there a little bit. It's the impact of falling commercial advertising revenues and navigating the tricky transition to a streaming first world. We spoke about the stock last in September. You'd recently made, I think, what you called a modest investment in your portfolio, but with some confidence. How are you feeling nearly half a year on?
Well, it's a small holding. It's not an over-important holding as far as but it's one where there is a very nice yield, I think around 7%. It has drifted a bit from the price I paid. I think I paid about 80 and it's nearer the 70 mark now. It's frequently talked about as a takeover situation because the view on the valuation of its production side is that production side is much more valuable than the present overall capitalization of ITV, and therefore the belief is that something will happen. I think the same to an extent applies with STV, where I've got a rather larger holding as well. Here again, the production side is highly thought of. And also from my experience over the years, when a company is pretty continuously mentioned as a takeover candidate, usually it happens at some stage. You can wait quite a long time for it. But I think it would be accepted that ITV at this sort of level is cheap and is vulnerable. And I'm happy just to, tuck it in the portfolio, receive a reasonable income from it, and just wait.
On that front, there's another company which I think you'll be receiving a reasonable income from. It was another new position for 2024. You talked about it at the top of the show, Supermarket Income Reit. You very briefly touched it on last time. Why, just to start with, supermarket real estate and not the supermarkets themselves?
Oh, well, because they're wholly different companies. The supermarkets themselves are essentially trading businesses and offer reasonable value, but quite obviously they're under attack, continuous attack from the overseas, sold and little, and the national insurance increases are going to hit the trading companies hard. Having said that, they're still going to trade profitably, or most are anyway. And so they're good, solid businesses, and I wouldn't dissuade people from what I would say. If you're invested in the supermarket sector, then broadly hold on. Although I wouldn't have thought it's a pretty attractive sector to buy into at the present time. Supermarket Income Reit is a wholly different business in that it owns the freeholds of, I think, 70-odd supermarkets and collects rents from those supermarkets. Now, of course, it's very difficult to get planning permission for a new supermarket. So the supermarket sites they own are valuable. The supermarket companies are well able to pay the rents in virtually all cases. So they've got a very good spread of solid, valuable real estate. They've pushed into France with the purchase of a dozen Carrefour stores. And also they've changed their management contract, which they've indicated should increase the bottom line. The shares yield, Supermarket Income Reit yields about virtually 9%, and the shares stand at a discount of about 20% to net asset value. Very attractive, a very attractive dual situation as far as I'm concerned. Within my ISA, alongside the financial high yielders like the Legal & Generals and the M&Gs, I thought this provided some quite useful non-financial spread and cover. And I'm very happy to have them in the portfolio on those fundamentals and receive this slowly increasing, but even now near 9% yield.
I suppose there's been quite a lot of consolidation or mergers within the investment trust and real estate investment trust space in the last couple of years, partly as a product of those big discounts and managers working out how to either correct for them or grow in order to build a bigger base for the future. So that's always a possibility. I suppose this isn't quite a lock and store replacement. I know you recycled the lock and store profits into, but that was a bit more of a growth story, wasn't it, with the warehouse shed?
Yes, I mean, lock and store was more of a trading situation, although obviously they did own a number of freeholds, but then increasingly became operators for others of self-storage, safe storage operations to be more sort of asset light. And it was a very well-managed business. And Andrew Jacobs, who built it up, had a lot of time for, and I think sold it at about the right time from every point of view. It was an AIM stock with all the qualifying advantages, taxation advantages there. And I think also that self-storage market is probably just a little bit over the peak now. So I think his timing was pretty good, and I was a beneficiary of that.
Any new positions or exits since we last spoke? I think that was the end of November when we were on here.
Yes, I think the supermarket income purchase was relatively recent.
Yeah.
I think the most recent new purchase has probably been MS International, where I used to be on the board many years ago. And this is a family-controlled engineering business. Originally, going a long way back, it was called Mining Supplies, and the business produced pit props. There were 2 or 3 companies that produced pit props when we had a coal mining industry in this country. And then, obviously, they had to diversify, and they bought years ago, I think it was Lawrence Scott, who were in defense. So the business has 3 divisions, 2 smallish ones, one manufacturing forklift arms, and also a second one which manufactures garage forecourts, the forecourt structure for the canopies and similar. And of course, there's been a lot of upgrading there as well. So those are 2 good, solid businesses. But the big business, the real growth business in MSI has been defense. Essentially, they are probably the world leaders in stabilizers for naval guns. It's naval guns that are their big forte.
There's certainly a theme it seems emerging in your portfolio. There's a couple of other defence companies you are.
I also bought
in
into Kinetic.
Yeah,
I've held that for somewhat longer, and I think that's showing about a third profit, something like that. I bought into it because I felt it's a high quality company, right at the forefront of technological laser advance in this country and in the US. And I thought when I bought that its price-earnings ratio was well out of line compared with the BAE Systems and some of the American defense contractors and Rheinmetall of Germany. So I bought, and I'm happy to have it in the portfolio. It's showing a nice profit. And I think that it's an attractive business and hopefully quite a way to go.
It's always interesting to hear how active you've been in your own portfolio, John. At least you've corralled a few members of your fellow members of the Lords into stock picking, or at least a stock picking game. I understand that you hold each year a competition where you pick. Is it one or a couple of
Yes,
stocks?
it's not actually in the Lords itself.
Okay.
But just to go back one stage, I'm a member of 3 investment dining groups, different groups of people, although 1 or 2 have the same people in. 1 breakfast, 2 dining ones in the evening. Thankfully, they don't all meet on the same day. Otherwise, it would be a little unhealthy. And in one of them, in 2 of them, actually, we have competitions, choosing a share at the start of the year, what will be the best performer. And in one of the groups, the winner gets a free dinner. And we have our dinner in the House of Lords, which is why you mentioned the House of Lords. Last year, I'm glad to say I got the free dinner because my concurrent technologies had pretty well doubled. And so I won the competition very easily.
Okay.
And if you want my recommendation for 2025, I chose PZ Cussons, a company that I know well, where I was on the board many years ago as a non-executive. Had a very difficult time over the last few years, particularly because of Nigerian naira devaluations. And the capitalizations come down from 1.8 billion to about 340 million, a massive fall, I think considerably overdone. But the company's now decided to divest itself of both Saint-Tropez, which is the leading American tanning brand, but more particularly to divest itself of the majority of its very substantial Nigerian interests. When that happens, I'm sure it will happen over the next 12 months, so it's bound to take time, then Nigeria won't have anything like the same influence on the share price that it has at the moment.
Right.
I think PZ Cussons will be looked at in a very different light. If you look at the brands that they've got in the UK, particularly Carex, which must be almost worth the total capitalization of PZ, let alone Imperial Leather and Cussons Products and Child's Farm, Sanctuary, that type of thing. And also they've got significant businesses in Australia and Indonesia. All these must add up to more than the 340 million capitalization. So I'm hoping for a free dinner again in.
I mean, it's subsidised already, isn't
but
it?
we will see. And in the meantime, there's on PZ there's a running yield of around 4.5%, something like that.
And I mean, the ball's running. It's been rolling there for a few months already, and I suppose it's a situation that you can talk about in terms of months rather than years.
Yes. Yes. I mean, I something is going to happen, this year and hopefully relatively soon. I think they've got a trading update or interim results in February next month. So we'll see. But at some stage this year, hopefully we'll receive some good news.
Without naming any names of any other contenders you see company-wise?
That would be my, that's one competition. And in another competition, in one of the other groups, we choose 3 stocks.
Okay.
And my 3 this year for 2025, just chosen, are difficult to choose because, I do have a number that I'm pretty optimistic about. But I came down to Anpario, which I think is trading well and I think is in a very good growth sector, increases dividend for the last 20 years every year, and cash rich. So I've gone for Anpario. I've gone for Christie's, massively undervalued, as I indicated. At some stage, something will happen there. People will recognize the worth of it. And PZ Cussons. Those are my 3 in that competition.
Okay, great. Well, that's about it. We've covered a lot of ground. I think that's probably about it for this month. If you do have any questions you'd like to put to John, you can do so by emailing me at alex.newman@ft.com. But until next time, all that's left for me to say is to thank you for listening. To John, as ever, thank you so much for your thoughts, your insight, and your candour in going through your portfolio. And to our producer, Maddie Apthorpe. And so until next time, goodbye.